Donald Trump's One Big Beautiful Bill is one of the most consequential pieces of tax legislation since the 2017 Tax Cuts and Jobs Act. It was signed into law in July of this year, of 2025, and it just brings a host of new benefits, new adjustments, and opportunities for taxpayers. I discussed those at length in one of my previous videos here on this channel. But it also introduces new traps for those who are not paying attention. So whether you are retired, maybe you're still working, or maybe you're running a household, there are some smart moves that you should consider before 2026 to make the most of what this new law offers. Because there's just so much information, I will cover these opportunities in several of my upcoming episodes, so make sure that you are subscribed to my channel here on YouTube and make sure that you ring the notification bell to stay connected. Let's break down in plain language what's changing, what it means for you, and what to do before the new tax season arrives. We'll cover the top 5 things that you should do to lower your tax bill. First, check your deductions if you're over 65. Starting in 2025, taxpayers over 65 years of age will see one of the biggest benefits in decades. If you're 65 or older, you will qualify for an additional standard deduction of $6,000 on top of the current bonus deduction that already exists. It means that if you're single and over 65, you can deduct up to $23,750 from your taxable income. For married couples where both spouses are over 65, that deduction doubles to $46,700. This change could mean real savings. A couple in the 22% tax bracket, for example, could cut their tax bill by more than $2,600 a year. But here's the catch. The bonus deduction begins to phase out for couples earning more than $150,000 in modified adjusted gross income, and it disappears completely if you earn $250,000. For singles, the phase-out range starts at $75,000 and ends at $175,000 per year. So if you're close to the income threshold, be very careful with moves that could increase your taxable income, such as converting a traditional IRA to a Roth, for example. Those conversions can bump your adjusted gross income, and suddenly that $6,000 bonus deduction could vanish, it could disappear. So be very, very careful with additional income that you choose to take in a tax year. If you do want to convert to a Roth, consider spreading it out over several years. That could be a good option. Consider keeping your income under the threshold if you want to get that deduction. So that way you still get the deduction and then you protect your retirement funds from future tax increases. And remember, the expanded deduction won't help everyone. Low-income retirees who already pay little or no income tax at all won't see much of a difference here, but for the middle-income households, it's a solid opportunity to keep more of your money home. Now, the second step to consider is for homeowners. Homeowners, especially in high-tax states, should take note of this one. The Big Beautiful Bill raises the cap on state and local tax deductions, known as the SALT deduction, from $10,000 to a much higher $40,000 starting in 2025. This is a huge change, especially for those living in places like New York, New Jersey, or California, where property taxes can easily exceed that amount. If you itemize your deductions, you will now be able to claim up to $40,000 in state and local taxes, including income, property, and sales taxes. The cap will even increase by 1% each year through 2029 before returning to $10,000 in 2030. But there is a warning here too. This higher cap starts phasing out once your modified adjusted gross income hits $500,000 and it is completely gone at $600,000. That means large one-time income boosts such as selling your stock or taking a big retirement withdrawal or even converting a large IRA to a Roth IRA can cost you your deduction. So be very, very careful. So again, timing is everything here. Space out your conversions, be very strategic about income events, and if you can, bunch your deductions. That is always a good strategy. Bunching means grouping deduction expenses like charitable donations or property tax payments into one tax year to exceed the standard deduction threshold that year. So for example, if you pay your 2026 property taxes in December of 2025, you can deduct both years' payments on your 2025 return, giving you a much bigger write-off, which is always a great chance. Now, the third step that you should consider taking to reduce your tax liability is take advantage of new charitable giving rules. Starting in 2026, taxpayers who don't itemize can deduct up to $1,000 in charitable contributions or $2,000 for married couples. This might not sound like much, but it is a welcome benefit for those who take the standard deduction. Donations to donor-advised funds and private foundations don't qualify for this new deduction, by the way. Only direct donations to charities do. If you want to maximize your deductions, you might consider pushing your regular contributions from late 2025 into early 2026 so that they qualify under the new rule. But for those who do itemize, there is a new limitation starting in 2026. The amount of charitable donations that you can deduct will be capped at the amount exceeding 0.5% of your adjusted gross income. So if you make, let's say, $100,000 and you donate, let's say, $700, you will only be able to deduct $200. That means that if you plan to make a large donation, it may make sense to do it in 2025 before the new limits kick in if you want to make the most of it. Now, the fourth step to consider is maximize your health savings account. The new law added several HSA-friendly provisions that start in 2026. For one, you will be able to withdraw up to $150 per month from your HSA or $300 for couples to pay for direct primary care or for concierge medical fees tax-free. That is a major win for people who use those personalized care services. The new law also makes it clear that having direct primary care will not disqualify you from contributing to an HSA as long as you also have a high deductible health plan. And here's another big change. Telehealth services are now permanently exempt from deductible requirements. That means that you can use telehealth without first meeting your plan's deductible, as it used to be the case. And of course, this is a major win for many who do choose to use telehealth. Step number 5, prepare for changes to health insurance marketplaces. The open enrollment period will now be shorter from November the 1st to December the 15th, starting in 2026. State-run marketplaces won't be allowed to extend enrollment past December the 31st. You will also need to provide proof of income eligibility for premium tax credits before you enroll, not afterward, as under the old rules. And if your income goes up during the year and you don't update your marketplace account, you could have to pay back excess subsidies when you file your tax return. That means it is more important than ever before to keep your income records up to date and to plan your financial moves like Roth conversions or capital gains with your health insurance cost in mind. So before 2026, here's your checklist. Talk to a financial planner about how the new deductions affect you. Be strategic about Roth conversions. Plan them ahead. If you own a home in a high tax state, manage your income to stay under the sole deduction thresholds. Plan your charitable giving carefully and make sure that your health coverage and your HSA strategies align with the new rules. Because when 2026 arrives, these opportunities that we just discussed will be already in motion, and those who act early will be the ones who benefit the most. Stay tuned for new updates. I post new videos on a weekly basis. Remember to subscribe, enable notifications by ringing the bell, and I will see you back here soon. I hope that you have an amazing day. Take care.